Let's get into this. The parallels between now and 2016. How strong are they?
They're not strong at all, because at the end of the day, the business cycle and earnings and also interest rates will determine kind of where stocks trade over the next year or two. And in 2016, as you recall, we went into that election with a lot of slack in the economy, right? Things were slow. We had a manufacturing recession around the world in 15, 16. The Fed was, rates were pretty low. Generally, the economy had a lot of slack from a labor standpoint. So it could receive kind of a pro-reflationary policy strategy. Today, we don't have that slack. So prices are extremely high. Consumers and small businesses are much more, I would say, sensitive to higher interest rates. So rising interest rates and kind of a pro-cyclical strategy, not going to be good for those types of stocks. And I think also the bond market now is in a much different position, right? We have way more debt, as you mentioned earlier. In 2016, we had plenty of slack in the borrowing markets. Today, we don't have that.
Here's what doesn't make sense to me then about the Trump trade. If you get bond yields that climb, how can risk assets keep rallying?
Well, I think it depends on why they're rallying. Okay, so I do think the equity markets are still nervous about growth concerns. I mean, the labor market's all over the place. I mean, people can make excuses for why it's better or worse month to month, but the general trend in labor is down. We're in a late cycle economy, so the equity market is worried about growth slowing, and that's why the Fed's cutting interest rates. Okay, so the bond market can't. I mean, the market goes up because growth is better, and people believe that, then it could be okay for equities. If bond market yields go up because term premium is widening, because of fiscal sustainability issues, then it's a problem.
Well, I guess the reason why I ask this is because the Trump trade the knee-jerk reaction supposedly is bond yields go up and equities rip, particularly in the more cyclical sectors. I'm thinking of financials. Based on the idea that you're not necessarily getting some sort of economic impulse that's immediately overlaid onto this scenario, why should risk assets continue to rally if yields continue to surge simply on this idea that the deficit's increasing and that bond vigilantes suddenly could be back?
Well, I mean, first of all, the financials is a little bit different because that's a dereg sort of call, and I do think that one's fairly visible. I think if you have a Trump presidency and maybe even a red sweep, you could get more lenient regulatory environment, maybe M&A picks up. That's kind of the financials trade, but that's unique. And we don't think the financials have really rallied that much on that trade yet. It's been more about the third quarter earnings season and the fact that we went into that earnings season with not a lot of high expectations. So I think there is scope for further follow through in certain quote unquote Trump trades. At the same time, there's probably the other side, which is that I think a lot of the negative trades have played out for the Trump trades. I mean, bonds have sold off probably too much. And the renewables and things like consumer goods companies that will be hurt by tariffs have really been hammered. So if Harris wins, you could see a pretty big rebound in some markets. So there's a lot of permutations here. It's not as clear cut. I think you said it exactly right. It's all about the setup. Okay, stocks and asset prices move based on positioning as much as they do about the actual news. I'm looking for a clearing event. Okay, I'm hoping this is a clearing event, and then we can kind of get back to doing what we get paid to do, which is analyze interest rates, earnings growth, and kind of multiples, trying to figure out, okay, what's the fundamental case here? And my guess is that could take maybe a month to kind of clear.
When it comes to a clearing event, would you agree with Kit Jukes that it's either likely going to be a Republican sweep or Harris with gridlock, a.k.a. Republican Senate?
Yeah, I think that's probably, that's what the prediction markets say. I mean, who am I to argue with that? But it's not like it's a slam dunk, okay? I do not agree with the view that a Republican sweep is the best outcome for equities. I think it's probably Trump with a divided Congress.
But a Republican sweep means a 15% corporate tax rate, potentially.
Potentially. I mean, let's see if they can actually get that through. I mean, the bond vigilantes may come for them if they try to cut taxes in that sort of form or fashion. And they're not even talking about. They're talking about at the margin trying to reduce some taxes, maybe extending some certain things. I think the bond market.
Margins, the whole election has been a tax cut election.
Yeah, but I don't think that's priced. Just like in 2016. Remember, in 2016, nobody priced that bond cut until December of 17 when the Senate actually passed it. I mean, the whole year is like, "There's never going to happen. It's never going to happen." I think the markets they always wait for the actual evidence to actually trade those types of events, particularly when it comes to Congress.
You said the most beneficial, Trump with divided government.
Yeah.
Can you explain that just a little bit more?
Well, the market's like uncertain. They don't want one party in power. I do think that a Trump, we said this all along, Trump presidency is probably more pro-growth, okay? Maybe not as good for bonds. Harris would be probably a little less growth, but probably better for bonds. And that's been our general view even prior to the last couple of weeks as things have kind of traded through. Now, at the margin, is it going to be dramatically better? I don't know. The markets have already priced a lot, right? You know what I'm saying? Like, that's the problem. We've already priced a lot of good news. And let's take a step back, too. We're trading almost 22 times earnings, okay? In 2016, we were trading 16.5 times earnings. So you got 5.5 multiple points of, we got to justify that no matter who wins this election. So we're just in a totally different setup going into this election.
So Ed Yardeni of Yardeni Research was on the program earlier this morning and essentially said to us, choppy road to nowhere, flat market into year end. Do you share that view?
Well, choppy meaning there could still be some big swings. I mean, maybe we end up flat from here to there, but there's going to be some big trading opportunities between here and there. I think we could see 6,000 potentially, in some sort of a clearing event that isn't, there's not a lot of consternation. People feel good about things. But then I think it's really hard for us to get past 6,000, 6,100 in any scenario, because then you're so stretched on valuation, and I don't see growth accelerating in a kind of way which would justify even higher multiples for 2025.
Can you explain what this clearing event for a month looks like?
No, I can't.
Okay, all right. Well, can you give us a sense of what that could mean? I mean, is it basically just whipsawing every single day, or is it basically that you see one trade in particular that you could see really getting blown up during that period of time?
Well, I could see many trades getting blown up, not just because of the election, but because, once again, we're very stretched. We're into the FOMO season, right? People need to perform in the next 2 months. There's a lot of things going on here. And so what I could see a blow-off move of some kind, post-election, a clearing event, but then reality sets in that we're going to have some kind of fiscal consolidation next year, no matter who wins. And in my view, I think that has to happen. And that, that's going to create uncertainty again. And then positioning gets kind of whipped around. The other thing that's going on is the Mag 7, which reported last week, was a mixed bag. What I was, we've been more pro-cyclical. What I was worried about last week was that they would come in with such great results that it would suck all the oxygen out of the markets again. So that didn't happen. But if we were to get a new theme, for example, let's say a new theme pops up, I can guarantee you this, the money's going to flock to that theme very quickly, because that's what we need right now. We need something to get excited about, and we're kind of lacking in that. But something will happen, right? In other words, the market will find a new shiny toy, and it will move to that shiny toy.
Right now, the Fed is not the shiny toy. We have barely mentioned the Fed's meeting on Thursday. How much does that matter to this entire equation?
Isn't it Wednesday? Or is it, you said it's Thursday?
It's Thursday. Decision
Thursday.
time.
Moved it back.
Yeah.
I know.
Okay.
It's very
the election.
unusual.
Yeah, but Wednesday, they're meeting on Wednesday.
Yeah, they're meeting on Wednesday,
fine,
but we
fine.
have the decision on
They're still
Thursday.
meeting. They're going to know what happened, or think they're. Anyways, yes. What do I think? I mean, they don't have any crystal ball. I don't think the election is going to change their decision making. So right now it's 25 basis points.
Do they change yours?
No, I mean, at the end of the day, the Fed's is somewhat on autopilot, assuming the economy doesn't take a really bad turn, then they got to cut even more rapidly. I think that the trick for the equity market is going to be what's their tone, the dovish tone or hawkish tone. Is it a hawkish cut or is it a dovish cut? But that's 1 or 2%. That's not a 10% move on the Fed. The Fed is kind of over here now. They're doing their thing. They made their decision. That was September. That was a shiny toy in September.
Right.
But now we've kind of got off of that, and now it's about earnings. And then as we go into year end, it's going to be how does 2025 settle in for the economy, for earnings growth, and where should multiples be based on how the equity markets are interpreting the move in bond yields.